Imagine a young woman named Jane. At 25, she decides to invest $1,000 in the stock market. She doesn't touch this money for the next 40 years. By the time she is 65, her small investment has grown to over $32,000. How did this happen? The answer lies in the magic of compound interest. Compound interest is a powerful tool in the world of investing. It means earning interest on both the money you save and the interest that money earns. This simple concept can turn even small savings into a significant amount over time. The earlier you start investing, the more you benefit from compound interest. Understanding and using compound interest can be the key to financial success. Whether you are just starting your career or planning for retirement, knowing how to make your money work for you is crucial. In this video, we will explore how compound interest works and offer practical tips to help you start your journey towards financial independence. Background and context. The concept of compound interest has been around for centuries. Ancient civilizations like the Egyptians and Babylonians understood the power of earning interest on interest. But it was the famous mathematician Albert Einstein who reportedly called it the eighth wonder of the world. So, what exactly is compound interest? In simple terms, it means you earn interest not just on your initial savings, but also on any interest that those savings have already earned. Think of it as a snowball rolling down a hill. As it rolls, it picks up more snow, growing bigger and bigger. In the same way, your money grows faster and faster over time with compound interest. The formula for compound interest might look complicated, but it's easy to understand. Here's a simplified version. A equals P, 1 plus R slash N caret NT. In this formula, A is the amount of money you'll have in the future. P is the principal amount, the money you start with. R is the annual interest rate, N is the number of times interest is compounded per year, and T is the number of years you invest. Many famous investors, like Warren Buffett, have built their fortunes by taking advantage of compound interest. Buffett started investing when he was just 11 years old, and over decades, his investments grew exponentially thanks to compound interest. Understanding compound interest is essential. It's a simple yet powerful way to grow your wealth over time. The earlier you start, the more you can benefit from this financial wonder. The science behind compound interest. Compound interest works like magic, but it's based on simple math. Let's break it down. When you invest money, you earn interest on your initial amount, called the principal. But with compound interest, you also earn interest on the interest you've already made. This means your money can grow faster over time. Here's how it works. Imagine you invest $1,000 at an interest rate of 5% per year. At the end of the first year, you'll have $1,050. In the second year, you earn interest on $1,050, not just the original $1,000. By the end of the second year, you'll have about $1,102.50. Each year, your interest earns interest, and your money grows faster. One helpful way to understand compound interest is the rule of 72. This rule helps you estimate how long it will take for your investment to double. You simply divide 72 by your annual interest rate. For example, if your interest rate is 6%, it will take about 12 years, 72 divided by 6, for your money to double. Time is a crucial factor in compound interest. The longer you let your money grow, the more you benefit. For example, if you start investing at age 25 and earn an average return of 7% per year, by the time you're 65, you could have significantly more money than if you started at age 35 with the same annual return. To see compound interest in action, look at graphs or charts that show how investments grow over time. These visuals clearly show that the longer your money stays invested, the more it accelerates in growth. In summary, the science behind compound interest is simple but powerful. By earning interest on both your principal and the interest it accumulates, your money can grow exponentially over time. Starting early and being consistent with your investments are key to maximizing the benefits of compound interest. Warren Buffett, one of the world's most successful investors, started investing when he was just 11 years old. He bought his first stock for $38 and sold it for a small profit. But instead of spending his money, he kept investing and reinvesting. Over decades, Buffett's investments grew significantly thanks to the power of compound interest. Today, he's worth billions of dollars. His secret? Starting early and letting his investments grow over time. Buffett often says that the biggest factor in his success is compound interest. So first, starting early gives your money more time to grow. Second, consistent contributions, even small ones, can add up significantly over time. Lastly, patience is key. Compound interest works best over long periods. These show that anyone, with discipline and time, can harness the power of compound interest to build wealth and achieve financial independence. Whether you're an average person or a legendary investor like Warren Buffett, the principles of compound interest can work for you. Practical applications. Understanding compound interest is just the first step. Here's how you can use it to grow your wealth. Start early. The sooner you start investing, the more time your money has to grow. Even if you can only invest a small amount, starting early can make a big difference. For example, if you invest $1,000 at age 25 and it grows at 7% per year, by age 65, it will be worth over $15,000. But if you wait until age 35 to start, that same $1,000 will only grow to about $7,600 by age 65. Consistent contributions. Make regular contributions to your investment accounts. This is often called dollar-cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer shares when prices are high, averaging out your costs over time. For example, if you invest $100 every month into a retirement account, you'll steadily build your wealth, even if the market goes up and down. Reinvest dividends. If your investments pay dividends, reinvest them instead of taking them as cash. This means you use the dividends to buy more shares of your investment. Over time, this can significantly boost your returns. For example, if you own stocks that pay dividends, reinvesting those dividends can help your investment grow faster through compound interest. Use tax-advantaged accounts. Take advantage of accounts that offer tax benefits, such as 401(k)s or IRAs in the U.S. These accounts allow your investments to grow tax-free or tax-deferred, meaning you don't pay taxes on your gains until you withdraw the money. This can enhance the power of compound interest because more of your money stays invested and growing. Automate your investments. Set up automatic transfers from your checking account to your investment account. This makes it easier to stay consistent with your contributions and ensures you don't forget to invest regularly. By starting early, contributing consistently, reinvesting dividends, using tax-advantaged accounts, and automating your investments, you can maximize the benefits of compound interest and build a strong financial future. Pitfalls and misconceptions. While compound interest is powerful, there are some pitfalls and misconceptions to be aware of. Common misunderstandings. Many people think that compound interest only benefits those with a lot of money. This isn't true. Even small amounts can grow significantly over time if invested properly. The key is consistency and patience. Inflation. Inflation reduces the purchasing power of your money. If your investments grow at 5% per year but inflation is 2%, your real return is only 3%. To combat this, choose investments that historically outpace inflation, like stocks or real estate. Taxes. Taxes can eat into your investment returns. For example, if you earn interest or dividends, you may have to pay taxes on that income. Using tax-advantaged accounts like 401(k)s or IRAs can help minimize this impact, allowing your investments to grow more efficiently. High-risk investments. Chasing high returns with risky investments can lead to losses that negate the benefits of compound interest. It's important to balance your portfolio with a mix of investments that match your risk tolerance. Diversification helps manage risk and can lead to more stable growth. Starting late. Starting to invest later in life means you have less time to benefit from compound interest. However, it's never too late to start. Even if you begin investing later, consistent contributions and wise investment choices can still help you grow your wealth. Impatience. Compound interest works best over long periods. Some people expect quick results and may get discouraged if they don't see immediate gains. Patience is crucial. Allow your investments time to grow and avoid making impulsive decisions based on short-term market fluctuations. By understanding these pitfalls and misconceptions, you can make smarter investment choices and better harness the power of compound interest to achieve your financial goals. Now, if you want to learn how to achieve financial success, then watch this video next. And if you made it to this point of the video, please like and subscribe to the channel to see more content like this. Thanks for watching, and I'll see you in the next video.